You know, when we're evaluating a business, it is incredibly tempting to just stop at net income, or maybe EBITDA. But if you really want to grasp a company's true cash-generating capacity, we have to look deeper. Welcome to today's Explainer, where we're unpacking free cash flow to equity, or FCFE. It's essentially the ultimate measure of what a business actually produces for its owners. And honestly, it's arguably an analyst's absolutely most powerful valuation tool.
Okay, let's dive into this. So, a lot of investors out there rely heavily on discounted dividend models to find intrinsic value. But you have to ask yourself, are dividends actually telling the whole story? Honestly, rarely. Dividends are totally discretionary. Management actively manages them, right? They often hoard cash, or they might even maintain payouts even when underlying profitability is dropping. So, relying solely on dividends kind of obscures the real cash value that's being generated or lost by the business.
Think of the difference using an allowance analogy. It makes it super clear. Dividends are just a discretionary choice. FCFE, on the other hand, is actual cash capacity. Imagine a teenager who has to pay for gas, car insurance, and put some money into savings. Whatever is left over after all that, that is their true allowance. For a business, FCFE is that exact allowance. It's the actual cash that can be safely distributed to the owners without hurting day-to-day operations, completely regardless of what the board actually decides to pay out.
So, the crucial point here really comes down to the definition. FCFE is the cash available to common stockholders after, and this is key, after all operating expenses, interest, principal payments, and necessary capital investments have been made. It is strictly a post-debt and post-reinvestment metric. The creditors, taxes, the business itself, they all get paid first. It's only after those non-negotiable obligations are met that we finally see the true cash left over for the equity holders. So how do we actually find this allowance? Well, the journey is actually pretty logical. Step 1, you start with net income. Step 2, we add back non-cash charges, like depreciation. Why? Because, well, that cash hasn't actually left the bank account. Step 3, subtract the capital investments that are absolutely required just to keep the business running. And finally, step 4, add net borrowing. You add this because any newly issued debt provides fresh cash that is technically available to the equity holders.
Now, what's really interesting about this is that there's actually a much faster alternative calculation. Instead of starting all the way back at net income, you can just look at cash flow from operations, or CFO. Since CFO already accounts for net income, those non-cash charges, and working capital, you literally only need 2 adjustments. You simply subtract your fixed capital investments and add net borrowing. Boom! It's the exact same result, but you get there so much faster.
Okay, so why do all this math in the first place? Simply put, to find the company's true intrinsic value. The equity value is simply the present value of all expected future FCFE discounted at the required rate of return on equity. It is the ultimate reality check. Basically, if the present value of all those forecasted future allowances exceeds the current stock price, well, you're looking at an undervalued stock.
Now, when you're projecting those cash flows far out into maturity, you calculate a terminal value. And you do this using a small but incredibly mighty denominator, R minus G. R is your required return, and G is the constant growth rate of the FCFE. Now notice the massive exponential impact here. Because you are subtracting growth from the required return, even just a slightly higher expected growth rate massively shrinks that denominator. And that drives the company's valuation completely sky high. It perfectly explains those massive premiums we see paid for growth stocks. Which brings us to a final thought to wrap up this explainer. If you took control of a company tomorrow, what would its free cash flow actually reveal? You see, as a minority shareholder, you pretty much just have to accept whatever dividend you're given. But a controlling owner, they can redeploy that FCFE entirely. They could aggressively pay down debt, acquire competitors, or just raise the payouts. FCFE tells you exactly what an owner can extract without breaking the business. So the next time you sit down to analyze an equity, look past the dividend, look for the true bottom line.